This options trading strategies video, we're going to talk about the long strangle. Now, the long strangle is an option strategy that profits from a large movement in the stock price in either direction. So if the stock price moves significantly to the upside or downside, the long strangle will be a good strategy. Now let's go ahead and get into the general strategy characteristics and then look at some real trade examples. Alright, so the long strangle is simply when you buy a strangle. So buying strangle is an option strategy that consists of purchasing an out-of-the-money call and put on a stock in the same expiration cycle. Now, though the long strangle is technically a neutral strategy, the long strangle requires a significant movement in the stock price or implied volatility to profit. So when you buy a strangle, you need the stock price to move up or down significantly, or you need implied volatility to increase in order to turn a profit. Now, since you do own a call option in this strategy and there's no limit to how much a stock price can rise, a long strangle theoretically has unlimited profit potential. Now, on the other hand, the most you can lose in this strategy is the debit you pay times 100. So let's say you pay a $5 debit for a long strangle, then the maximum loss potential is going to be $500. So it's that $5 debit times 100, since the standard option contract multiplier is 100. Now, the expiration break-even prices are going to be the long call strike price plus the debit paid, and the long put strike price minus the debit paid. So that debit you pay actually moves your break-even prices beyond the strike prices that you purchase. So just keep that in mind. Now, since you need a large movement in the stock price or an increase in implied volatility to profit, the estimated probability of profit for the long strangle strategy is less than 50%. And that's because as time passes, those options are going to be decreasing in value from time decay, and to offset that, you need a large movement in the stock price or an increase in implied volatility. So the probability of profit is low. Now, the resulting position after expiration depends on if your long call or long put is in the money. Now, if your long call is in the money at expiration, that option will settle to plus 100 shares of stock per long call option. Now, if your long put is in the money, that position will expire to negative 100 shares of stock per long put. So you'll be short 100 shares of stock per put that you own. Now, in regards to assignment risk, there are no short options in this strategy, so the long strangle has no assignment risk. Alright, well, now that you know the strategy characteristics, let's go ahead and hammer all those points home by looking at an actual strangle example. So here we have a hypothetical option chain, and we can see we have various strike prices ranging from 180 to 220. Now let's say at the time of these option prices that the stock price is currently trading for $200, and we believe the stock price is going to make a significant movement in either direction. So we're going to buy a strangle, and to do that we're going to buy the 190 put for $3.78, and we're going to buy the 210 call for $4.31. Now that's going to bring our net debit to $8.09. So the put price plus the call price, which is $8.09. So based on this position, let's go ahead and take a look at the expiration risk profile graph. Alright, so this is the graph of this strangle position that we just initiated. So on the x-axis we have the various stock prices, and on the y-axis we have the profit and loss based on those stock prices at expiration. So as we can see here, we purchased the 190 put and the 210 call. Now, as we can see, our maximum loss potential is $809. Now, that's because we paid an $8.09 debit for this strategy, and since we have to multiply that by 100 to get our maximum loss is $809. Now, that maximum loss occurs when the stock price is between our long put and long call strikes at expiration. So if the stock price is anywhere between 190 and 210 at expiration, we will lose the full $8.09 debit that we paid. Now, our break-even prices are the long call strike price plus the debit paid, and the long put strike price minus the debit paid. So our break-even prices in this example are 181.91 and 218.09. So to have a profit at expiration, we need the stock price to be above 218.09 or below 181.91. So as we can see, we need a pretty sizable move in this stock but before this strangle expires if we want to have a profit. Now, as we can see, if the stock price increases significantly or decreases significantly, we have a lot of profit potential. So For example, if the stock price falls to $140, our profit is estimated to be $4,191 per long strangle. Now, on the other hand, if the stock price increases to $260, our profit is going to be the same. It's estimated to be around $4,191. All right, now let's briefly discuss the strategy's option Greek so that you can understand how the strategy will perform before expiration. All right, so now we're going to talk about the long strangle's Greek exposures, and then we're going to look at some real trade examples to show you how the strategy performs in various scenarios. All right, so first and foremost, a long strangle's delta will vary. Now at trade entry, it's very common to have a delta neutral strangle, which basically means you're buying a call and put with offsetting deltas. However, you can trade a directional long strangle by purchasing options with unequal deltas. So for example, if you buy a 30 delta put and a 10 delta call, you'll have a slight bearish bias because that put delta is larger than your call delta. Now in regards to gamma, a long strangle has positive gamma, and that means that when the stock price rises, the long strangle position becomes more long because its delta will grow positive, and when the stock price falls, a long strangle position becomes more short because its delta will grow negative. So what that means is that if the stock price starts trending upwards, you're going to get long, and basically you want the stock price to continue that movement because with your positive deltas, that means that you're going to start profiting if the stock price continues to rise. Now the opposite is true on the downside. Now in regards to theta decay, a long strangle's theta is negative. Now that means that you're going to lose money as time passes, all else being equal. Now that's because as time passes, the extrinsic value of options decays, and that leads to decreasing option prices, which is of course not what you want when you own options. And lastly, a long strangle's position vega is positive. Now that means that you profit from increases in implied volatility and lose money from decreases in implied volatility. Now that's because increases in implied volatility indicate that option prices are increasing, which is obviously great for strangle buyers. Now on the other hand, a decrease in implied volatility indicates that option prices are falling, which is not good for strangle buyers. So when we put all of these Greeks together, we learn that a long strangle profits from significant stock price movements in either direction, an increase in implied volatility, and the long strangle loses money when time simply passes and the stock price or implied volatility remains the same, or when implied volatility decreases. So to make money with a long strangle, you need an implied volatility increase or a significant stock price movement in either direction, and if time simply passes and none of those things happen, you will lose money. So now let's get to the fun stuff and actually look at real long strangle trade examples to demonstrate to you what I just explained. Alright, so the first example we're going to look at is a maximum loss long strangle, and obviously that happens when the stock price is between the long call and long put strikes at expiration. So here is the setup. The initial stock price is 212.44, initial implied volatility is 14%, and we're going to buy the 201 put and 219 call that expire in 63 days. Now our net debit for this trade is going to be $2.58, and that's going to bring our break-even prices to $198.42 and $221.58. And that stems from the put strike price minus the debit and the call strike price plus the debit. So of course our maximum profit potential is theoretically unlimited, and our maximum loss in this case is the $2.58 debit times 100, which is $258. So let's go ahead and take a look at what happens to this position over time. Alright, so in the top part of this graph, we're looking at the changes in the stock price relative to our long call and long put strike prices, and we also can see the upper break-even price and the lower break-even price of this long strangle position. Now on the bottom part of the graph, we're looking at our entry price of the strangle and the changes in the price of the strangle and any corresponding profits or losses relative to the current price of the strangle and the entry price. So in this case, we can see that the stock price remains right between our long call and long put strike as time passes. So, of course, that means that these option prices are decreasing over time because they're getting closer and closer to expiration. And since the stock price is, staying right in between those options, there is a lower and lower probability that those options expire in the money and they become less valuable. So, In this case, we can see that the strangle starts around $2.58, and as time passes, that value slowly decreases towards zero. Now, at expiration, the stock price is right in between our long call and long put strike price, and we can see that the strangle expires worthless. So if we were to buy one of these strangles for $2.58, if we held it until expiration, we would lose that full debit paid, and we would have a loss of $258 per long strangle. Now, you don't have to hold a position until expiration, and you never have to do that when you trade options. So let's say you wanted to lock in your loss when this strangle hit $1. So if you bought it for $2.58, once the strangle hit $1 and you wanted to cut your losses, you could simply sell the strangle for $1 and you would lock in a loss of $158 as opposed to the maximum loss of $258. Now, of course, when you lock in the loss, you're out of the trade and you remove the potential to profit from it in the future if it does end up in the money. Alright, in this next example, we're going to look at a collapsing stock price after a long strangle is initiated. So obviously that should be a very good thing for a long strangle position. So here's the setup. The initial stock price is $524. Initial implied volatility is 26%, and we're going to buy the 495 555 strangle that expires in 39 days. Now our net debit for this trade is going to be $12.55, which brings our break-even prices to $482.45 and $567.55. Now that stems from the long put strike price of $495 less the debit of $12.55 and the long call strike price of $555 plus the $12.55 debit. Now our maximum profit potential is unlimited, and our maximum loss potential is limited to the debit we pay times 100, which comes out to $1,255. So let's go ahead and take a look at what happens to this position over time. Alright, so in the top part of the graph, we're looking at the changes in the stock price relative to our strangle strike prices and break-even prices. And in the bottom part of the graph, we're looking at the changes in the price of the strangle as the stock price is changing. So clearly in the beginning, we bought the strangle for $12.55, and we can see that initially the stock price just remained between our long strikes and lost a little bit of value. Now, around 26 or 27 days to expiration, we can see that the stock price falls from around $530 all the way down to $460, which is well below our put strike of $495. Now, while that stock price decrease is happening, the strangle's price increases from $12.50 all the way to around $48. So, that's almost a 4x move. So, if you bought the strangle for around $12 and it was worth around $48 at one point, you'd have a profit of $36 per strangle, or $3,600 in actual dollar terms. So this demonstration just shows that if the stock price makes a significant move in either direction, a long strangle position will expand in value because one of those options is going to be increasing in value. So in this case, when the stock price collapsed, the long call was actually losing value, but the long put was making up for it more than enough. So in this case, the strangle price went from $12.50 all the way up to around $48. But as we can see, the stock price did end up rallying back in between the long strikes, and this strangle did expire worthless at expiration. So in this particular example, the profits on the strangle didn't really matter unless the trader who owned this strangle closed out those options. So this is just an example of, you have significant profits on a long premium trade, but those profits erode away quickly as the stock price reverses. So you definitely have to have a management plan in place when trading long strangles. Alright, now earlier we talked about a long strangle having positive gamma, which means its directional exposure changes in the way that the stock price is changing. So using the previous example, we're going to look at the same stock price movement, except we're going to look at the strangle's position delta as the stock price is changing. So in this case, we can see that the position delta started around 0, which means we basically had no directional exposure to changes in the stock price. Now, as we can see, when the stock price decreased and was below our long put strike price of $495, our position delta was growing more and more negative. Now that means we would benefit from continuations of that downside movement because we have a negative delta, which means we make money when the stock price decreases. So This is just a good example of how a long strangle can begin market neutral, but as soon as the stock price starts trending in one direction, you want that movement to continue. Alright, so let's recap the main concepts that you've learned from this video. So first and foremost, buying strangles is a directionally neutral strategy that consists of buying an out-of-the-money call and put option in a stock in the same expiration cycle. Now, the main profit drivers of the long strangle strategy are significant movements in the stock price because the strategy has positive gamma, and increases in implied volatility because the strategy has positive vega. Now, to close a long strangle position before expiration, you can sell the long call and put at their current prices to lock in any profits or losses that you have on the position. Now, due to having significant profit potential and limited loss potential, the long strangle strategy has a low probability of profit. And lastly, though the strategy begins delta neutral, the position will become very directional if the stock price trends in one direction, which we just discussed.